Hello, how's it going, everyone? I'm having problems with my microphone right now. I'm trying to see if I can fix that. Can you guys let me know if you can hear me? I think my microphone's not working, so I'm trying to use the audio from my laptop. Let me see here. If you guys can't hear me, can you guys let me know? My microphone is just not fully working right now for some reason. I'll post it in the chat. You guys can hear me? Awesome. Awesome. Okay, so it should be posted within 1 minute here. Let me see if I can pull it up real quick so I can let you guys know what the interest rate report is. So I believe it's going to be posted right now, and then within 30 minutes at 2:30, Jerome Powell is going to be speaking on what the future outlook is going to be looking like. So we got 20 seconds here till it gets posted. So for those of you that don't know, the current interest rate is 4.25 and the forecast is 4%. So means most likely it'll go down by a quarter percent, which is a good thing. It's about to be posted right now in the next 5 seconds. Let's see how this reacts. I think will probably go down by a quarter, and then might see a little pump, but it really will depend on what Jerome Powell says in the next 30 minutes. And it looks like yes, it's been lowered by a quarter of a percentage point. So it went down from 4.25 to 4%. And let's see, looks like Weeble's not really reacting all that well right now. It's going up a little bit, nothing too crazy. Let's see how the rest of the market is doing. I really thought we are going to get a bigger reaction than this. But like I said, the main event is going to be at 2:30 when Jerome Powell is going to be talking. Right now, we just got interest rates lowered to 4%. For those of you who own houses or cars, anytime you borrow money, it's going to be slightly cheaper to pay the interest on it now. That's a good thing because when interest rates become extremely low, we usually see a flood of money enter the markets because a lot of people like to borrow money to invest into stocks and all that. So, let's see, Ethereum, crypto. I mean, a lot of stuff's not reacting all that much to it. We are starting to go up a little bit, nothing too crazy. I'm going to look at the 30-minute time frame right now. This is our support from the previous day right here. This was our lowest point this morning. We put down all the way to 11.3 cents. Not a good sign. This usually means that we are starting to create lower lows. But on a bigger time frame, like the 4-hour time frame, this could be a positive thing because if we take a look during that main sell-off, we reached 1052 and then we bounced. We kind of started like going up, but then we lost confidence when we got close to the CMA, pulled down, not quite as low, and then went and broke through the 4-hour EMA. This is the first time we broke through it since that huge sell-off started. But then the first time we break through it, there's always usually, from my experience, we always go down to retest the low to see if we can create a higher low. A higher low would be if we reverse here or if we pull a little lower but don't go quite as low as we did over here and then re-break that 4-hour EMA, that's going to be a really positive signal. So I'm really trying to see if we during at 2:30 if we're going to break that 1140 mark. If we do, we probably will retest $12 again. And then if we go past the 11.99, that's when we see a reversal and we most likely will pull to 13. So let's see how the rest of the market is reacting. If you guys are trading Webull or if you guys have any questions, let me know. Just post it in the chat here. The market's not really reacting all that crazy. Bitcoin is kind of even. We got Apple not up all that much. Nvidia up too, I mean, decent amount, but it was already up on the day before. So not a huge reaction today. Almost seems like everything's been priced in. And Webull is trading exactly at the same price. If we look at the 1 hour time frame right here, the EMA line is almost pretty much it's doing the crossover now, but if by 2:30, if we bounce through that, that would be such a good sign. And on the 4 hour time frame, we just need to stabilize and then reverse. That would be amazing. That would be such a positive thing for this to happen. We'll see exactly what happens, but what time is it now? 2:04. I really wanted to take a trade, but I was expecting more of a reaction on this. I really thought if we pulled down, I can hop in closer to under $11, but we didn't pull down. We also didn't have a significant push. So if we re-break the 4 hour EMA, I will open a position because that would be a really big positive sign. But if we go lower, I will be waiting until we push down to about, well, closer to 11. I mean, 1080. If we can get there, then I'll open a position, but I don't want to do it right now. This isn't significant enough of a reaction. Wow, that's really not doing anything, huh? I will keep it on the 30-minute time frame right here. Let's see what it does. Our current support is 1103. That was in the morning where we pulled down. I think we definitely have more momentum now at 11, but because of the yesterday and today how we broke this, confidence has been lost a little bit. So the goal is, even though we lost some confidence, the goal is to stabilize around this point because then we could really start pushing up. If people realize it's not selling off quite as low as we did before, that's when we'll start seeing big gains. But we still need to see that. On the 4 hour time frame, if we look at our RSI, we are almost in considered an extreme oversold area, even though we're not quite as low as we were at 1050. And the reason for that is because of this push, and we are now slowing down. We're not selling off quite as much. Wow, we really expected more of a reaction on this. Like the whole stock market is not really reacting. Solana coin 196. That's pretty much what it was. It wasn't even. It wasn't even. I mean, we're pulling down a little bit, but we were at 198, $2 up. 30-minute time frame, pulling down a little bit. I will open a trade, but I want something to happen. I want to pull through the support and go lower so I can get in at a better price. Or if we can push up and re-break the 4 hour EMA at 230, then that's when I'll open another position here. I just don't want to do it in the middle. I want to open it down here, or I want to open it up here because then we'll show a lot of confidence. Let me see if I can look something up to see why the market's not reacting as much. I think it's because everything's been priced in. We kind of expected this already to happen. So yeah, the press conference is going to be at 2:30 p.m. Eastern time. So I got the press conference over here on this my other screen. We'll see when once it starts, but as of right now, there's still another 20 minutes remaining. I kind of wish we had a bigger reaction so that we can, if we had some more volatility, we could have opened up some trades here alive, but it just looks like there's just not enough volatility. But let's break down on what happened in the past month real quick. So once we had this huge sell-off occur, we had such a huge amount of panic right here, and then we bounced a lot, but we didn't come up to the 4-hour time frame. We then sold off and went way lower and had another huge wave of panic all the way to 1052. Look at this wick, how quickly we closed it, and the same thing happened here. This is showing more confidence, like people are buying at this price. But then as we started showing confidence, started pushing, then we started losing momentum, losing some steam. As the 4-hour EMA came closer, we sold off, reattempted to retest it. A lot of people got scared. We went lower. We did not go quite as low as the 1052, and we bounced at 1054, showing a lot more confidence all the way till we broke the 4-hour EMA. The first time that happened since the whole sell off started. The first time we break the 4-hour EMA, most of the time we always go back down to retest this loading zone. If we can restabilize and go back up and re-break it, that would be a huge signal because this would be a higher low. That would be the first time this happened. And then if we can re-break the EMA, most likely we will retest the $12 zone again. The more we test it, the more chances we have of breaking through it. And if we break through it, 11.99 was the highest point right here. If we break through that, then we can be assured that we most likely will retest $13. We are so close to finally have this reversal. This is just the next step that has to happen. We have to pretty much sell off, and then we just have to pretty much stay here to not we not can't go as low as we did here. If we go all the way lower and re-break this, then yes, confidence is lost and we'll have another huge step down. But as of right now, that has not happened, and we have good odds of going up. So we'll see what happens here. I really hope that Jerome Powell says some good stuff so we can start pumping back up. Let me see. They did decide to lower interest rate to 4%. I think that's because the inflation report that we had, the forecast was 3.1, and we actually came in at 3% flat. So we came in a little bit lower than what was expected. The economy is starting to slowly slow down. There's definitely some slowdown in the labor market and just everywhere across the board. I think they needed to lower interest rates so that we can slowly start stabilizing the whole economy. Um, we'll see what Jerome Powell says because he always has at the very beginning. If you guys is the first time watching, he always has like a little speech that he does. That's the same speech early on, and then the market just starts really reacting to it, even though nothing. He hasn't even said anything crazy. The market just starts reacting. But then it'll really depend on what the sentiment is. If he's going to be saying a lot of good things, a lot of positive outlook for the future, more interest rate cuts, if he's going to be saying any of those things, the market will take that as a good sign and start pricing in future interest rate cuts. And that's when we'll start seeing this go up a lot. But if he's going to be saying negative things, saying that we're going to keep interest rates longer, if he's just not going to be saying a lot of good things, we could possibly sell off or we could stay at this price. But it's just really at this point, technicals don't matter. It just really is going to matter on what he says. So if this is the first time, it's better to reduce position size. It's better to not go in as heavy. Like if I open a position, it's going to be lighter than normal because the market is influenced a lot more right now. We will stock just testing this whole $11 support here. We are really low right now. We are not breaking through our lowest point of the day yet, but we are pretty low. We are at 1107. We will see if this pumps right before Jerome Powell starts speaking. A lot of times the direction changes right when he starts talking for some reason too. Even though he hasn't even said anything, that usually it happens as well. The rest of the market is kind of, let's see what it's doing. Tesla's just been around 460 all day too, not really doing anything. Cryptocurrencies are kind of pulling down, nothing major. Got Robinhood stock just sideways. And the reason you see all the sideways movements because the market just doesn't know exactly what's going to happen. There's technicals, like I said, technicals don't matter. Go back on Webull stock. We're at 1105 right now. On the 30-minute time frame, the EMA looks like it's about to have the crossover. A lot of times I've seen before the crossover happens, we attempt to go up to see if we can re-break it. So we'll see if that little pump happens. But like I said, technicals don't really matter right now. It's just really that's the main thing is what he says. Market's pulling down because they are thinking he might be saying a couple of bad things, but nobody really knows what he's going to say. Yeah, that's the kind of mindset you have to have. If you are a long-term investor, like you said, Facebook, Meta, all those stocks you bought, when you are investing into the future, you especially something that has growth. We've already looked at this, the revenues of Webull. We are growing. So in the future will be worth more. If you're trying to short-term trade this, by the way, we just broke support 1103. We are at 1101. If you are trying to trade this, though, this is where you have to have stop losses. You have to have risk management. If you are going to the future and you're loading up in zones like strategical zones, you don't really care where price this is on right now. You're just getting it at a really good deal because it will be worth more money in the future. Wow, those are some amazing prices you mentioned there. Meta 95, Palantir 750. Yeah, when you bought Meta at $95 and it's, worth like 5, 6, 7 times more than what you paid for, that's a pretty crazy return. You just you can't expect Meta to go back down to 95 at this point. And I think in the future, people are gonna look back at this and they're gonna be like, "Wow, $11, $12, Webull was trading so low. I could have loaded up so much." That's there's not a lot of there's not a lot of pretty much good things. I mean, we do have a analyst saying that this should be worth like $18 a share right now, but we don't have a very positive outlook on it right now. And that's kind of the gamble that we have to take. But if we do it in increments, like I've seen people go in their entire accounts and they freak out on a small pullback. If you went in a portion of your account, if this goes down, you always have more buying power to load up at better zones. If it goes up, well, at least you're making money on your first position that you entered. So if you do it strategically, you're not going to be stressing out about this all that much. Somebody said keep selling, cover call. Yeah, you can make money both ways. You can make money shorting this, you can make money going on it long. It just depends where you enter and if it makes sense. Like right now, we don't have the best sentiment, so shorting is a good thing. You can make money both ways. This doesn't mean that this stock is going to be falling forever. We could recover, and as long as you have risk management, you can make money shorting this. You can then go long and then make money on the way back up. You can make money both ways. So as long as you're strategical, that's not a bad thing. We got, what time is it now? 12 more minutes. You might want to be careful. If you're really heavy in, you could possibly reduce position size. I can't tell you what to do with your money, but if this is the first time you are ever watching this, sometimes we really reverse when he starts speaking. So even me, I'm not opening a trade yet, but if I do open one, I'm going to be slightly less position size than I normally am, just because the volatility usually is crazy when he starts talking. Looks like we're still above the $11, which is a good thing. Hopefully we bounce around here. Let's see, we got 11 minutes left. If we do pull back to about 11, I mean, not 11, 1080, I will open a position going long. I just don't want to do it at this price because we could possibly break support and have a step down, and I would rather get in at a better price. But if we pump, I won't open a position because then I'm not getting in at a good deal. I will only open a position if we re-break the 4-hour EMA, which would be at 1140. So I'll either open a position after 1140 or I will open a position at, well, I'll just do around 1075 because then I can get in at a better deal. But I don't want to do it right here in the middle. I'd rather get in at a way better price, or I'll get in when the momentum is showing upward momentum. Because if I'm going to take a risk to go against this when it's selling off, I would rather get in at a way better deal. I usually don't like to trade when the direction is against me. Like right now, the direction is downward. So, like I said, I only open a position against the direction if I get in at a really good deal. It looks like we are testing that $11, 10.99. We're just selling off right before he starts speaking. No, whoever was shorting this made some money today, huh? I wanted to, but it was it was already pretty cheap in my opinion. And then at the same time, since the interest rate is going to be dropped, we saw that coming. I didn't want to go against that because we could, just as fast as we came down, we can pump just as fast back up. So in the 4-hour time frame, we are coming down, but this would be amazing if we reverse because then this would be a higher low. I really thought we are going to have a lot more volatility, but Looks like we're just slowly selling off right before he starts talking. That usually does happen because a lot of people don't want to hold through the speech, kind of like me, because the volatility could be against you. You could make a lot of money, but your stop losses have to be really tight. So a lot of people choose not to trade. They sell out before, especially with the lowering of the interest rates that it was already priced into the market. So we are at $11 flat right now. We got about 5 minutes left till he comes out and starts talking. I'm going to try to play it through the screen. Hopefully, you guys can hear the volume of it. If not, if you guys can let me know, but I think it should be able to hear the volume. What if we just hit $13 a share like in within 5 minutes? How amazing would that be? I know that would make a lot of you guys happy. If that were to happen, if we would break the $12 range, I wouldn't even sell out. I would just put a trailing stop loss because that would indicate a reverse of pattern. Let's see what Apple is doing. Everything's just kind of waiting on this speech. TQs. This is the NASDAQ market. Even the NASDAQ market is not really responding to this right now. It's not really selling off or going up. We're almost at break even on the day. Crypto's not reacting. Under 4 minutes left. Can you guys see this screen? I'm trying to put up a window I don't think you guys can see it, huh? There's 1 minute left till he starts talking. And once he starts talking, let me know if you guys can hear the volume from it. He hasn't started yet, but he should be coming out right now. Looks like he should be starting. It says now waiting for the PBS NewsHour, so they're just waiting on him to start, but he should be starting right about now. It looks like Webull is starting to go back up a little bit. Looks like we're bouncing off that 1097.
And delayed due to the shutdown. The public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today, the Federal Open Market Committee decided to lower our policy interest rate by a quarter percentage point.
Him talking right now or no?
We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and we'll reinvest the proceeds from those securities in treasury bills, furthering progress toward a portfolio consisting primarily of treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut as a foregone conclusion at your next meeting?
Well, as I just mentioned, A further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year where you made a sequence of adjustments and then waited to gather more information?
We are at
So
1084.
the way we
will.
have been thinking, well, I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire. Claire Jones, Financial Times. Thank you for taking this question.
Looks like we're starting.
We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns and some will be more averse to underruns of employment. And so you put that together. And as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the US Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we see, that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really, in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views? Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
Just to follow up on the balance sheet, if you stop at the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in treasury bills, which will foster both a more treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long, but at a certain point, you'll want to start reserves to start gradually growing to keep up with, the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple of things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths. And so that, if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that. And the thing about tariff inflation is the base case is that it will come and it probably will increase further, but it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that? And especially when we're seeing potentially labor supply challenges.
Sorry, say the first.
The stubborn services inflation that you mentioned.
Service inflation. Yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And, you know, overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and I mean, financial services that are imputed rather than actually paid is a big part of that. But also just, you know, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because, you know, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber, Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. You know, there are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
You know, this is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things, that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs. And much of the time they're talking about AI and what it can do. So we're watching that very carefully. Yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well,
the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
And so on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
I look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have in fact cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's, and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants. And now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now? And what will this rate cut do to improve the job market?
So I think there are two things affecting the job market. And one of them is just a dramatic reduction in the supply of new workers. And that's two things. That's declining labor force participation, which is a cyclical thing. And then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers is going down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to zero. So maximum employment doesn't, on a sustainable basis, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. So it's a complicated situation. And some people argue that this is supply and we really can't affect it much with our tools. But others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths, maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level, and then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are. And that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
You know, we don't look at any one asset price and say, hey, that's wrong. You know, it's not our job to do that. We look at the overall financial system and we ask whether it's stable, whether it could withstand shocks, right? So, you know, banks are well capitalized while some households are clearly under stress. In the aggregate, you know, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not, it's not appropriate. You know, we don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that.
All right, seems like there's not much more that's going to be said. So the reason for this sell-off is because there might not be an interest rate cut in December. That's my take on it. That's the biggest thing that was said. We did pull a little bit lower, but so did the entire market. I think once the market restabilizes, Webull should come back. It looks like we are already trying to test the EMA line right now at 11:05. We'll see before market closes. We still got another 50 minutes. We'll see if we re-break this. That would be a good thing. As of right now, we are just still recovering that sell-off that we had right before this speed, so we can come back to the same price. But I appreciate you guys watching. If you guys can drop a like, because I'll be covering on what this stock does day in and day out. So I appreciate you guys watching and commenting and all that stuff. But it looks like we just are re-breaking the EMA line, which is a good thing, 11:08. Hopefully we can close back up above this support. That would be amazing. So I'll make sure to cover this later on today. But yeah, I'll see you guys later.